A single number can decide whether you pay an extra $200,000 for the same house as your neighbor. It can determine if you qualify for an apartment, whether you get approved for a car, sometimes even whether you get the job. Yet most people have no idea how that number is really built, or who profits every time it changes. Because your credit score isn't just measuring your financial life. In many ways, it's shaping it. By the end of this video, you'll understand why millions of Americans spend years chasing a higher credit score without ever questioning the system behind it. We'll uncover how credit scores were created, who benefits from them, why small mistakes can follow you for years, and why playing the game perfectly still doesn't always guarantee financial freedom. Because the biggest trap isn't having bad credit. It's believing your credit score is the same thing as your financial health. For the score. There was a time when your credit score didn't exist. If you wanted a loan in the 1950s, you sat across the desk from a banker. The banker looked you in the eye. He asked about your family, your job, your reputation, sometimes your neighbors, sometimes things that had nothing to do with money at all. The process wasn't objective. It wasn't consistent. And for many Americans, it was deeply unfair. Women often needed a male cosigner. Minorities faced discrimination. Approval depended as much on opinion as on income. Banks wanted a faster way, a cheaper way, a more standardized way. So they turned people into data. And that's when everything changed. But creating a score solved one problem, while quietly creating another. Turning people into numbers. In 1989, the modern credit score arrived. Instead of asking who you were, lenders began asking what your data said about you. Every credit card payment, every loan, every missed bill became part of a permanent financial history. On paper, it sounded fair. Computers don't have emotions. Numbers don't play favorites. But numbers also don't understand context. Lose your job for 3 months. Miss a payment. That mistake can stay on your report for years. Recover financially. Increase your income. Pay every bill afterward. Your score may still lag behind. One difficult season can become a long-term financial penalty. And that's where the real cycle begins. Because your score doesn't just reflect your past, it changes your future. The price of a lower number. Picture two people buying the exact same car. Same dealership, same day, same vehicle. The only difference? Their credit scores. One qualifies for a low interest rate. The other doesn't. Over the life of the loan, they could pay thousands more. Not because the car is different, because the number is. Now multiply that across mortgages, student loans, business loans, insurance premiums, even security deposits. A lower score often makes everything more expensive. Ironically, the people with the least money frequently pay the highest cost to borrow. But here's the question. If the system predicts financial risk, why does it sometimes make escaping financial hardship even harder? The invisible rules. Most people think paying bills on time is enough. It's not. Your score watches far more than that. How much of your credit limit you use, how old your accounts are, how often you apply for new credit, what types of debt you carry. Even closing a credit card, something that feels responsible, can sometimes lower your score. Pay off a loan? Your score might temporarily dip. Open a new account? It may fall again. The rules often feel backward because the system isn't rewarding people for avoiding debt. It's rewarding people for managing debt in ways lenders consider predictable. That's a very different goal. And once you see that difference, the entire system starts to look different. Who really benefits? Banks make money by lending. Credit card companies make money when people borrow. The more accurately they can estimate risk, the more confidently they can lend. Credit scores became the language that connected borrowers with lenders. But there was another business growing quietly in the background: your financial data itself. Every payment, every account, every application. Information became an industry. Companies built businesses around collecting, organizing, and selling credit information. Lenders gained faster decisions. Consumers gained easier access to credit. But they also entered a world where financial reputation could follow them almost everywhere. And once enough industries trusted that number, its influence spread far beyond loans. When a score becomes an identity. A credit score started as a lending tool, but today, its impact reaches much further. Some landlords review it before renting an apartment. Some insurers may use credit-based information when setting premiums, depending on state laws and the type of insurance. Certain employers, particularly for roles involving financial responsibility, may review aspects of a candidate's credit history where legally permitted. Suddenly, one financial mistake can echo across completely different parts of life: your housing, your transportation, your opportunities. That's why millions become obsessed with protecting the score itself. But here's the irony. You can have an excellent credit score while carrying tens of thousands of dollars in debt. You can look financially healthy while quietly falling behind. So what is the score actually measuring? The trap. A credit score measures one thing remarkably well: how you've managed borrowed money. It does not measure your savings, your investments, your emergency fund, your net worth, your financial independence. Someone with a perfect score